All right, well, welcome everybody to the client support webinar. Today is July 3rd, and that is 2024, and happy July 4th to everybody tomorrow. I think July 4th is one of my favorite holidays. For some reason, I really like it. Weather's good usually, and gotta love the fireworks, right? All right, so a couple announcements here. I don't know if it's going to be next week or the week after. I think what we're going to do with the client support webinars is start holding them in the afternoon. I'm too busy during the morning, I'm day trading, and I don't like to take a break from that and then go back to it. So I think what we're going to do is put the client support webinars and probably move all our webinars that are normally scheduled in the morning to the afternoon. So we'll send an email out to you all on that, but I think that's kind of where we're going to go on that. All right, so if you have any questions, feel free to go ahead and type those in the question area. All right, and I'm just going to go through a few administrational items while you guys do that. All right, so first thing, of course, are the risks involved in trading. Like I always say, without that risk, there is no opportunity. That pretty much goes through to everything we do, right? In life, anyway. All right, so make sure you know what your risks are whenever you take them. And don't be afraid to take them, because there's times when you just certainly have to do that in order to get to the next level. Same thing with trading, right? But you want to basically know what your downside is and try to know that before going into a situation where you're trying for profit, but there's also risk involved. And I'm very big on that. I've written a couple of books on risk control. So to me, that's a very important aspect of this business. If you don't have good risk control, it's just a matter of time. And the funny thing with risk control is, I'll just spend a couple minutes here, is that, you don't, there's a risk to reward, and there's also the fact of your win percentages. And so when you have a very high win percentages, you don't have to have a higher risk to reward all the time. Okay, so normally we like to have a 2-to-1. But that's more on trades that have a more win percentage of around 60% or 50, even 50%. You want to have that 2-to-1. But there's certain scalping techniques that we use that were actually good above 80%, and our risk to reward only needs to be 1-to-1. So it depends on the situation of how often you win, your win percentages. And that's kind of important. So keep that in mind when you're putting something together. For example, if you're a scalp trader, all right, chances are you're going to be in and out of the market very quickly. You can also be, and that would be a day trading situation, but it also could be an end of day situation, depending. But if you were day trading using a scalping technique and you're winning 80% of the time, your risk to reward does not need to be 2-to-1. In fact, if you jumped it up to 2-to-1, you may find your win percentage is coming down. However, if you are trading the intraday trends and you're in that trade for a lot longer than you would be a scalp, then those particular wins will be much greater per trade when you're trend trading like that. So therefore, your win percentages may be a little bit less, but your rewards are going to be much higher than if you're scalping on each trade. So you have to basically create a formula based on how you trade. Okay, I think that's really important. So, it's different, a little bit different for everybody, but you need to come up with an edge in risk control, but also in your actual trading, obviously, that works for you over time. That's the key. And that's where testing comes into play and so forth. So just kind of keep that in mind. If we, look up any stocks also here, don't forget, I don't know your personal situation. So I may recommend something, but that may not be suitable for you. So run everything by your financial advisor or whoever manages your money. All right, what else can I say about risk? All right, in the markets, no guarantees. Everything is probabilities, percentages, and the idea is you want to be on the right side of the percentage curve more often than not. And you can do everything right on a trade. You can do everything, the setup can be exactly perfect. And that trade may not work out because it's probabilities. All right, so keep that in mind. All right, in terms of talking about funding your account with money you can afford to risk, I'm recommending prop firms for those day traders that do that on the futures market. I'm going to put a coupon up if you're really interested in doing this. I think it's a great thing to do. I use them, and basically you pay a flat subscription fee for the evaluation accounts that include your data. And then when you're successful and reach the goals of the prop firm, they switch you over to a real funded account where you can actually start earning 90% of your profits. So it's a great way to get into the markets, develop your success rate, get funded, and then use that success rate in order to make money on an ongoing basis. And so I think it's a real good way. You're not risking any money except for the fees you pay. So I think that's a real good way of doing it. Now, but just check with there's different prop firms. I recommend Apex. They've been around the longest. I think they do a pretty good job of everything. But there's others out there, okay? So you can check them out. There's others that can be more expensive that I have found. So I think Apex is a good blend of quality and the cost. What else can I say about that? In front of you, you can see the payouts. I mean, those are the actual payouts that they've done this year. So they do pay out. I know traders that are getting paid out. So that's, it's legit that way. What else? You can have more than one actual account. So in other words, the real people that make money on this scalping, a lot of them scalp. What they'll do is they'll have you can have up to 20 accounts. And then you can copy your trade. So if you do a trade on one account, it copies to all 20. And so let's say you make, I don't know, 200 bucks on a trade, on a scalp. Well, if you have 10 accounts, that's 2,000 bucks. If you have 20, that's 4, right? So that's big money. So that's where you make your money. You don't have to make $5,000 a day because you only have to make 200 if you're copying your trade. So that's kind of a cool thing, I think, about the prop fund. But you have to have an edge. You don't have an edge, then you have nothing. So you have to develop and practice your edge first to get it down. And, you know, I would go slow at first and tiptoe into how to do it better. I think I'm going to have a tutorial this fall, and I think we're going to have quite a bit of the tutorial focus on how to do the prop trading. So I think that's kind of where we're going to go with that, I think, this fall, because a lot of people are into it. It's very popular, and it really is a great way to get involved. So keep that in mind if you're interested in tiptoeing in, and I gave you a code up there that you can get a discount. All right, books, money management, there they are right in front of you. My new book, The Art of Trading, 2nd edition, coming out this fall. So it's done, all right? It's going to be about 500 pages, give or take a couple hundred pages, depending on the layout they do, but it's a big book. Elliott Wave Techniques Simplified is in there, and so you can check them all out. I'll put, you know, links up there. All right, how many people have the Art software? Frank, how are you? Good to have you here. We missed you the other day in the day trading. But we will, no day trading tomorrow, obviously. Markets are closed, so we'll be back on Tuesday in the day trading room. All right, let's see what we got here. Okay, so, all right, good. So we got a lot of people using software and a lot of different platforms. Thanks for telling me the platforms. So our software works on NinjaTrader. Our software works on TradeStation. It works on multi-charts. It works on MT4, MT5, and eSignal. All right, so all those major platforms. And we're always looking to possibly add others. All right, depends on how many people we have using them, et cetera, et cetera. So we got software that are that go right on the charts and scanners and risk control. So we try to cover all the major bases with our software. All right, so that's kind of the administration stuff to cover today. Let me just talk a little bit about some of the things that I wanted to talk to you about. I'm going to bring up the whiteboard. Okay, we covered pyramids. Remember, we spent a whole time on pyramids. Do we need to cover any of the indicators? Let me ask you guys. Is there anything specifically that you want to cover today? maybe giving you a hard time. Don't forget, this is your webinar. So if I don't hear back from anybody, then I just cover topics that I think are good to know. All right. But I think we covered the OWL as well, right? I think we went over that. All right, Alexander would like a little bit more on the OWL PTF. Okay, 1 and 2B reversals. Excellent. Okay, so let's cover those. So the OWL and PTF we'll cover first, and then Frank will go over the 1Bs and 2Bs. So the OWL does what? What does that measure? What if you had to, in one sentence, say what does the OWL do? What does it do? Anybody? Okay, measures momentum, right? Okay, I'll put momentum here. What else does it do? Our OWL, anyway. What does the OWL do? And what does it stand for, by the way? What does OWL stand for? It's an acronym. Elliott wave, excellent, okay? Elliott wave, okay, good. And it stands for optimum wave locator, right? Excellent, okay. A+ on that. All right, PTF. First of all, what does that stand for? What is that an acronym for? PTF. Precision trend filter, very good. And what does it do? No, not necessarily. Alexander's saying find trends, not really. We use the art software for that. Overbought, oversold, let's not say that really. I don't like those terms either, but I get what you're saying, okay? All right, so the precision trend filter basically tells you when a market is either gonna make higher highs from a probability standpoint or lower lows. And it does that by generating either a green color for bullishness, higher highs, or a red color for bearishness and lower lows. Now, if the color, however, is neutral, it's yellow, okay? Yellow means nothing, okay? So when you see a yellow color, that means almost like a neutral reading. It's kind of like if you had a buddy of yours that you were trading with, and that buddy, let's call that buddy PTF, okay? And you turned to the buddy and you said, what do you think? Are we gonna have higher highs and more higher highs? Is this trend over or is it gonna continue? He's gonna say either it's gonna continue, it's neutral, or it's gonna go lower. Those are the only three things he's gonna say. And if you turn to him and he's neutral, he's just gonna say, I don't know. Could go either way. So the PTF is either bullish, bearish, or neutral. That's all you have to remember, okay? Now, the OWL, how is that represented on the chart? How is the OWL represented on the chart? How is the OWL represented on the chart? Right, histogram, right? So those are those lines. It's at the bottom of the chart, and it's represented by a histogram where each histogram is plotted along with when a price bar plots, okay, up on the main chart. What about the PTF? PTF basically is either green, red, or yellow. Basically, that's all you have to know. All right, so now let me just take a moment and let's just take a look at what an OWL and PTF look like. So this is the OWL right here. and this is the PTF down here. And I've got it on all three charting platforms. So when it's yellow, it's neutral. Now, what does neutral mean exactly? It means that you as a trader, all right, can take either a long or short trade. It's not going to keep you out of a trade when it's neutral or yellow. You can go long or short. However, okay, if it's green, like over here on this time frame, you don't want to go short. You don't want to go against it because it's saying higher highs are coming, okay? So higher highs are coming. So the owl, when it plots the owl, the histogram, this is the 0 line, is obviously going to be above or below. Above or below, okay? So basically, a very easy way of using the owl is that we look for divergence, but we also look for a long trade to be sure the owl is green. Okay, short trade would be only red, right? So that is a filter we use depending on the type of trade we want to take. So, you know, if I'm scalping the market, I might want to wait and scalp that to the short side when I only have a red PTF. If I'm trend trading, I want to use this in conjunction with trading in the direction of the trend, okay? So I think that's kind of important for you to realize. And then certain histograms will create what we call an Elliott wave 3 reading, where it is identifying wave 3 in an Elliott wave sequence. But basically, very easy way to use it. If you're thinking a long trade, just make sure the owl is green. Now, another way you can intensify that is if you had the owl, and let's say you had price up here, and we had a pyramid forming here, and then prices went above it. Well, if you have, let's say you have a little bit of a negative owl, and then it comes back up. When the price bar clears the top of the apex or point of the owl, there's two ways you can even get even more specific with it. A, you don't want to go long unless it's green to begin with, right? So that's the first step. All right, in this example, we meet that qualification, right? However, another way to do it too is have that in place, but also add another criteria. Is this price bar, the one that's going over the apex, is it higher than the previous one? And if it is, you can take the trade. If it's not, don't take it. And see if you get a pullback, and then on the next move up. So if it was kind of like this and then moved back down, and we got a downward move here and then came back up, if that one then is higher than the one that preceded at the apex, you can take it then. So that is kind of a very specific way of doing it, and a very more strict way of doing it, okay? And some people prefer it, okay? Some people simply prefer that. So that's kind of a bunch of different ways you can use it. All right, so Alexander's got a question. Here's my question. I'd like to know when a 60-minute owl is red, okay? Daily is yellow. Okay, you mean PTF, right? Not owl, I think. All right, so the 60-minute owl is red. The daily is yellow or something like that. There's divergence. How do you know which divergence to follow? All right, the 60-minute chart, regardless of what indicator or anything, that should always happen before the daily. And the daily should always happen before the higher time frame. So if you have a bullish 60-minute chart, but a bearish daily chart, then chances are you're going to get a bullish move before the daily bearishness comes in. Okay? Does that kind of help you? I think that's what you mean, right? I got my whiteboard up here now. So for example, we have on this, okay, we have on this a green now, right? So now you want, what is that green? First of all, what's the green PTF telling you here? Okay, that it's going higher than here, right? I'll tell you what a great example is on this. Let's go to Bitcoin, all right? So here's a great example, all right? So we've got now a red PTF on both the daily and the 60-minute, but we have a green one on the weekly. So overall, the long-term trend is up, but what we're experiencing here is a correction, right? And so this is saying the correction's not over. So this is your fib where we think it's now going to. All right, this is red, so it's still heading down. So after this gets completed and heads back up, all right, this will be a 5, this will be a 3. This looks like an ABC now. This is a 4, and then we'll have 5. This may not even go red because we're still in 3. All right, so here's an example where you have long-term, you have a bullish market. Short-term, it's indicating a move down because it's in a correction. All right, so that's important. So the PTF will alternate from color to color when the lower bands are broken by the actual oscillator in the PTF. Okay. And there's a 75% probability of accuracy on this. So when it goes from a green to a red, that's actually one of the 25% times that it was wrong. So it was predicting more highs. So we thought there was a bottom in here based on this and the possibility of an ABC, but now that bet is off because A, we're coming down. It looks like we're going to take out that low now and go into the target. So things change. So instead of being bullish short term, now I'm bearish. And that's, you have to flow with the market. Okay. So when things change, you got to change with it, but at least know when it's changing. Okay. That type of thing. All right. We'll save fractals for another day, Frank, I think. But thank you. Remind me next week, okay? All right. So let's go back to Alexander. So again, maybe a whiteboard for this, Alexander. So on the PTF alone, all right, it's at the bottom of the chart, looks like this. In it, there's 2 lines in it. And there's an oscillator. So when the oscillator breaks the upper band, it turns the PTF green at that point. Even if it falls back in here, it's going to remain green. And basically what it's saying is that eventually, whatever price bar created this line to go above the upper line here, whatever price bar, there is a 75% probability that the market will return, even if it pulls back and go above there. So if you're trading the markets and you think that, oh my gosh, this is a top, but this is green, the PTF turns green, then you have a couple choices. One is you have a 75% probability that this is not the top, that the market at some point will return and come back and take that out, even if it pulls back. So the PTF is not going to tell you the market's just going to keep going up, because what the PTF is saying is that that's not the top. The market could pull back before again going above the top, or it could keep going, but it's not telling you that. It's only telling you that that price bar is not the top. And so any pullback, chances are, is just a profit-taking pullback. Now, if you have a PTF, for example, that is yellow, and the market, well, let's just do this. we have a PTF that's green here, all right? And the market goes up and it turns yellow on this price bar. So let's say we had a situation like this. Let's say we had a move up here, created a green, and then we had a move down here. All right, so we had this created a green PTF. So this turned the PTF green. And it was remained green even when the market was selling off. Okay, and then the market returns and goes higher here, but the PTF turns yellow. That means the momentum was not strong enough to keep it green. And so now we could be looking at a top because it's neutral. Doesn't mean it couldn't keep going up, because it could. And it doesn't mean if it goes up, it couldn't turn green again. But it's just telling you at that particular point that the momentum was not strong enough to keep it green. And it's going to stay green in this scenario. Don't forget, all right, before you have this happen, it's going to stay green until that peak is taken out. Or if it's wrong, then if it comes down again and turns it red over here, then it was wrong. So whenever it goes from a green to a red or a red to a green, it was just wrong. And that's going to happen 25% of the time. That's why you always have to use risk control, because if you get slammed on that 25% time it's wrong, you don't want to have a huge loss. So you want to be smart about your position. But also too, you know, if you're back in here and let's get rid of all this, and it's green, chances are more often than not, and you see it turn up and a move back up, you want to be long here because it's going to take out that high. So it'll work more in your favor than against you. But you still have to use risk control, because we never know when those times come where something's not going to work like it should. All right, does that explain PTF? Okay, so now the next question he's asking, this is a good question. All right, if the PTF is between 20 and 80, it will be yellow. Well, yes and no. Let's do our PTF again. So here's the 80. I'll just put 8. And here's the 20. If the PTF already went above the 8 and then dropped below the 8, it's going to be green, even though the oscillator is between the 8 and the 20. You understand that? Because it penetrated it up here. Now, in price, that may look something like that, let's just say, okay? And then it pulls back, all right? And then it comes back up again and goes higher. But if this line does not go above the 80, it's immediately going to turn yellow. Is that clear? And keep asking if it's not. Now, this is the PTF. We're not talking about the owl here, just the PTF. No, color will not change on the retracement. The color will stay green because it exceeded the 80 here, and it will stay green until price either goes above the apex and does so not strong enough to keep it green, therefore it's going to turn yellow, or it's going to be wrong and if price goes down and abruptly turns it to red because this line goes below here, okay? I'm glad you're asking because it's a little tricky to get the hang of it. So PTF's a little more OWL's a little more straightforward. For right now, just long positions, if the histogram is above, you want to go long, and you can take short positions when it goes below. That's easy, okay? But the PTF's a little bit more involved. Let me ask you a question. Let's take a look at this. Let's just draw this out again. So here's the PTF, and I'll just do a dotted line for the 80. And I'll actually write out 80. And then I'll do a dotted line for the 20 down here. Okay, put 20. All right, now we got price. So let's say it's yellow right now, okay? Price is trucking along here, okay? The oscillator's here like this. It's just yellow, you know, it's going back and forth and meandering, okay? Then all of a sudden you get a big price bar up like this. And so this turns this line going from here up, and it peaks up here. All right, stays kind of like that, peaks up again, this line's above, and then it pulls back. All right, what color currently is the PTF? What color currently is the PTF in this scenario? Good, because it exceeded the upper 80% line, even though the oscillator line retraced below it, right? All right, so what does that mean? You as a trader, what does that tell you? Do not think in terms of overbought and oversold. Just think in terms of what it's telling you. Okay, so right away, what color is it? You said green, right? And when did it turn green? Right here, right? So it was yellow all the way to here, now it's green. So even though we've had a pullback, and let's say the pullback continues, and this goes down here like that, it's still green because it hasn't gone below the 20% line. So currently, let's just say you weren't in this trade, but now you're saying, oh, I got a green PTF. This is interesting because now I know there's a 75% probability that we'll go above this high. All right, so let's do this. Let's see if it turns around. So maybe it does one of these type of things. So it comes here, starts to turn around, all right? Pulls back, goes down again, pulls back up, and you get a pyramid. Would you take the trade? Would you take the trade? Anybody? Would you take the trade? Yes, good, Clifton. Yes, because you got two things being met here. You got a pyramid, okay, and you got a PTF telling you there's a 75% probability that we're going to go above here. So right away, if I put my stop at the pyramid and I enter here, my risk to reward is already 2 to 1 to that top. So that's a trade we're taking. Does that make sense? All right, so now Alexander is saying, okay, so how would you correlate that with the owl? Well, if the owl, let's say the owl is above here, so this is the PTF down here, and the owl is here. So this is the 0 line on the owl. So if the histogram was coming up here, pulled back here, and then started surging forward again here, and then here, because the owl is above the 0 line, so that's bullish, right? This is bullish, and you got a bullish pyramid. So you have 3 things. You have a bullish owl and a bullish pyramid. So you have a bullish triangular pyramid, you have a bullish owl, and you have a bullish PTF telling you more highs are coming. So if you had that like a checklist, check, 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 that would be good, right? And if you were one of these super strict persons, then this owl is higher than the one that was created at the apex. So now you have a 4th checklist that works. Does that make sense? Okay. So you got to understand this concept before you think about other time frames for a moment, because then you can apply this on each time frame. And if you want to be super strict, if you have a neutral or green on the lower time frame, well, there's nothing, in terms of PTF, that's not holding you back, because you can go long or short on a neutral. You just don't want to go long if you have any red PTF on any time frame that's shorter than the one you're trying to trade. Frank, I think what we'll do, since we're kind of over on time, if you don't mind, I think we'll do the 1B and 2B next week, okay? Just remind me, okay? Alexander, does that make sense? This was a good session, Alexander. I'm glad you asked these questions, because I know other people probably have it too. Good question. I'm not leaving right this second, so you're okay. You don't have to run off, but I just want to make sure you got it, okay? Okay. Well, this is recorded, so it will be, in the recording area where you can review it again. Just don't overcomplicate it, okay? And remember, when you look at the time frames, look from left to right, okay? Look at the 60, and that's what should happen before the daily. Then look at the daily, and that's what should happen before the weekly. So if you're thinking about taking a long trade on the daily, but the weekly shows a different picture, a bearish picture, then probably that you want to wait before your long position, wait for the bearishness to subside on the smaller time frame and see if the daily chart in this example would still be bullish. And if so, your timing will be better. Okay, great. All right, well, listen, great session. Thank you so much. I love the questions. The questions are really what this session is all about. So again, let me just repeat a couple things here. One is we're gonna be moving basically the client support and also my market review that are usually held in the morning to the afternoon. I'm kind of busy. I need to be, trading during the market hours. So it's hard for me to stop and go. So we're going to move these events, these webinars, all to the afternoon after the market closes. And I think that'll be probably better for everybody. Then you can focus in on the markets. And then we'll come here for our educational in the afternoon. All right, super. Okay, so that's it for today. Okay, thank you so much. Have a great July 4th, and we'll see you back here next week. Again, wait for the email for us to tell you what the new times are. It may start next week. We may start the week after. Got some things we got to get done first. So in any case, but eventually that's going to happen, and we'll send you an email in plenty of time before. All right. Well, thank you, everybody. Frank, thank you. Alexander, thank you. You guys have a great week, and we'll see you back here. Good turnout today. Glad to see everybody. All right. Take care. Bye-bye now.